went up when the interest rate went down. It was a coupon plus world. We are moving into a coupon minus world. So if you buy yourself some bonds, you got in a normal bond bear market, not one that's too severe, you got an expected nominal return pretty close to zero. You'll lose in your principal loss what you're getting in your yield. And how attractive an investment is that? Even if inflation is only 1.5% or 2%, you get zero. This is pretty unexciting. So that is driving people out to look at riskier assets as an alternative. Yeah.
So, you talked about a dollar, keep in mind.
You talked about a dollar bull market. Okay, so it says, maybe I want to own dollar-based equities, not euro-based equities. But then you just said profit recovery in Europe. And I'm thinking to myself, it's just a disaster if you travel in Europe. I mean, it looks like here in 2008. It's closed storefronts everywhere you go in Europe. And I personally don't see what they're doing that can possibly change that. And I don't know that quantitative easing is going to do it, in less than 20 years. So my first question is, what is there a silver bullet that if they had the political will, they could do something? And number two, is this profit recovery in European industries enough to make you ever want to own euro-based assets in front of dollars for the next few years?
Yeah, it's an interesting question. First, there's a fundamental issue, and then there's an investment strategy question behind the fundamental issue. On a fundamental basis, my long-term outlook for Europe is it's kind of an old museum. They got some nice old stuff we can go look at, but they're not going to have much in the way of strong economic growth, innovation, etc. They have a serious demographic problem in Europe. The Italians have forgotten how to manufacture Italians. The Germans have forgotten how to manufacture Germans. And so there's an aging of the population. This is very dramatic in Germany, of all places, where the workforce is now starting to decline. Reduced number of workers. Well, that's going to hold back the growth of the economy. It's one of the reasons why the Germans are so much about a debt break, about a balanced budget type amendment in the German context, because they say, hey, if the number of workers in Germany is going down every year, we sure better not be raising our sovereign debt that we owe, because we have fewer and fewer per capitas that's going to be able to pay on that. In addition, it's badly managed. Europe has a bad system. The euro was designed for political purposes, not for economic purposes. Right now, they're very afraid Russia might cut off the natural gas this winter because it's run by a former KGB guy, with the caveat that there's no such thing as a former KGB guy. So you got to feel a little nervous. Now, having said that, you have cyclical profit declines and recoveries in a lot of badly managed countries. So there are times when the best performing stock market is Argentina. There are times when the best performing stock market is Venezuela. There are cycles even in countries which have really bad long-term challenges. So in the case of Europe, whereas we had a single recession, they had a double-dip recession, because the ECB was dumb enough to tighten monetary policy when you had an oil price spike in 2008, just before the global financial crisis, and they were dumb enough to tighten again in 2011. There was a little pop-up of energy prices. They said, wow, we're worried about inflation, so they raised interest rates. And they also had, if you may remember, the euro crisis. Would Greece go bankrupt? Would Portugal go bankrupt? Would Spain go bankrupt? would Italy go bankrupt? So they had a second financial crisis in Europe. So they basically, and then they had a very weak recovery that you could barely detect. So whereas the United States has already had a big profit recovery because the economy came back from a very severe financial crisis and recession, Europe hasn't had that cyclical benefit play out in anywhere near the fullest sense. So if you believe as I do that the euro is going down, possibly to 100 over the next several years, but you believe there's going to be a profit recovery because their growth rate can pick up a little bit in 2015, 2016, 2017. I think there'll be a little reflux of confidence in Europe once they get to about January. If the Russians haven't cut off the natural gas by January 15th, they can basically say we've made it through the winter because they got enough reserves to keep going. I think that'll cause a real sense of relief. So if you have a dynamic where you expect a good profit recovery but a weak currency, what you're supposed to do is invest in the equity fully hedged. Now, I'm on a lot of investment committees at our firm. I'm on the Wealth Management Investment Strategy Committee. I'm on the ISS, the Investment Strategy and Solutions Committee. I'm on our pension. We have about a $5 billion pension fund for the firm. And I'm advocating that our investment in developed equity markets, like Europe, like Japan, be 100% fully hedged. And I've had a tough time selling this. And in addition, I've had a tough time identifying good vehicles to execute this. And the entire investment industry, whether it's pension funds or wealth management operations, basically has gotten in the habit of not hedging their international exposure because for 10 years it didn't make any difference. And those who tried to do it said we're wasting our time with it. But this is not just a little cyclical fluctuation. This is a trend. This is a powerful trend. So the logic is you buy Japanese equity hedged, you buy European equity hedged, so you get the benefit of a profit recovery without the offsetting loss. But many, many accounts today, they will have, if you look at it, the S&P's up, what, 11%, and the DAX in dollars is down 7%. That's 1,700 basis point spread due in a substantial way to the currency. So my advocacy is that investing in, it makes sense to invest in these equity markets but it really makes sense on a hedge basis. And keep in mind, the entire industry is structured a different way. 3 years from today, the consultants will come in and they will say, well, we found 3 guys who were hedging for the last 15 years. And they each managed $5 million each. They have now grown to billion-dollar investment management companies, and they are 3 recommendations for your developed international equity. And all of a sudden, they'll end up with $100 billion. Of course, by the time they get $100 billion, it'll be kind of too late because the euro will already be at 100, and by the time the consultants get it all figured out and find the product, it's already taken place. So that's my interpretation, is that there's good potential returns in hedged investment in the ZIRP countries, zero interest rate countries. Look what happened in the United States when we ran so many years with a zero interest rate. Stock market went up a lot. And I've been fighting the bears for the last 5 or 6 years who kept saying it's all going to blow up, and the answer is it's not easy to blow up when you have a zero interest rate. They didn't actually have a zero interest rate in Europe for the last 5 years, 6 years, because they were dumb enough to tighten up in 2011 and gave themselves a second financial crisis. So, I'm sorry to be so ambiguous in my opinion. Yes, question over here.
What's your scenario if oil prices drop to 35? And this dire doom and gloom about that, does it make your scenario better, or is there a point where there are serious trade-offs to that?
Well, it makes the scenario for the global and U.S. economy better. It makes the outlook for oil importers, including Europe, Japan, China, and India, much better. U.S., not as much a benefit as it used to be because we have domestic oil oil production. We've got an expansion in that part of our economy. There would obviously be defaults and losses, but we can absorb that within a broader system. Studying Nigeria, I mean, they got a huge problem if something like that takes place. But for the big economies, the biggest economies in the world, so when you consolidate together the beneficial impact of the U.S., Europe, Japan, China, India, that's a big chunk of the world. But differentially, you would have terrible conditions in a lot of these areas that are producers of raw materials. I don't think you can stay at $30 or $35 for very long because while Saudi Arabia wouldn't have to shut down as a result of that, what would occur is you would stop investing in developing new production around the world. One of the things about the shale oil business is they're very different than like the Saudi wells. Saudi wells, think of it as putting like a tube into a giant lake and then producing oil for 50 or 60 years. That's not what we're dealing with this shale gas and this shale oil. We know where they are, so we don't lose a lot of money on dry holes. But on the other hand, they deplete very fast. So you get a lot of production out for a year, 2 years. After 3 or 4 years, the depletion is very fast. It's very different than, say, in Saudi Arabia and the Middle East, where it slows down very gradually. So you go to $30 oil, $35 oil, you cancel all those capital spending programs, and you wait 2 years. And all of a sudden, this thing rolls over in terms of new production as they cancel all the capital spending plans. But it would be a short-term shock to the oil exporters, and it would be a real benefit to the oil importers. Now, some of the oil exporters also have problems. Like, for example, in Brazil, think about free market pricing. Petrobras found some great oil reserves and oil areas. And as a result, the stock market priced that stock at $70 a share. They have not revised down their estimates of how much oil is there. But the government made the choice, under the leadership of a populist government, to set rules which made it tough for Petrobras to make a profit. So currently, the stock is trading for 7 and 3/4. 70 to 7 to 7 and 3/4. So what's going to be their drilling? Is their drilling, if we go to $30 oil, are they going to be able to afford to have the same drilling program that they have had recently? I think the answer for many projects, both offshore, onshore, and elsewhere, is they get canceled. So the oil market would rebalance. We wouldn't go to 30 and stay there. We might be at 30 for a month, 2 months, 3 months. We're not going to be there for 3 years. It's just that dynamic doesn't work.
We have time for one more question. Who are you looking at here? Yes. Go ahead.
Can you comment on what I would call excess dollars going to IPOs, private technology markets, whether it's Uber or Lending Club pricing today, 20 to 1 oversubscribed, that kind of intense interest and speculation at this point?
Yeah, it's an issue. It's a problem of reckless excess, and therefore it's a very good thing. We've done this before. In 1999, we had a monetary policy that was easy for different reasons. The reason it was easy in 1999 was the economy was booming, and Greenspan was afraid of, what was he afraid of in 1999? Anybody remember? Y2K.
Yeah.
Would you like the hours back? Ed Yardeni, yes. Ed Yardeni, after telling everybody how bad Y2K was gonna be, went the next morning, when it was nothing, he walked into his morning meeting and he said, well, Y2K didn't work out exactly as I expected, but I want to let you know I'm becoming increasingly worried about global warming. That must have made him really popular. So look, the Fed is, in some senses, trying to drive up the price of risky assets to encourage economic spending. And one of the side effects is that you get, in some cases, a recovery of depressed asset prices to where they should be. In other cases, you drive it way above where it should be on enthusiasm. What we discovered in the aftermath of 1999 is that some of these new technology businesses have low barriers to entry. Think of a classic kind of Porter analysis of a business. You may have a brilliant idea, but it may be easy to copy. So the first 3 guys out raise money at a really great price, but by the time the 20th guy gets financed, somebody figures out that you don't own this space anymore, that basically you got a lot of competition coming in at you. Now, some of these will be the Facebooks, the Googles, the Amazons. They'll be the ones that ultimately reach great scale. Some of them will be the JDS Uniphase. They're still in existence, but they're no longer worth nearly $1 billion. The way they, no, it was like, $500 billion. It was an incredible amount of valuation on a company that did, and then some will just be total bankruptcies. So this is an artifact of using this zero interest rate policy to stimulate the economy. The Fed can't control everything. These are free market risks. They aren't leveraged into the they aren't intermediated in the banking system. So if you issue 100 IPOs and they all go to zero, that does not destroy your banking system because those assets are not owned on a 10-to-1 leverage in your banking system. You just have some individuals who lose money. If 99 of them go bankrupt and one of them goes up 100-fold, some people are lucky and some people are unlucky. And that's the capitalist system. In the meantime, you're financing lots of ideas, some of which will work. Notice, you look other countries of the world, Europe, China, Japan, you don't see a Facebook, you don't see a Google, you don't see an Amazon. So the downside is that you lose money on a lot of these things. The positive side is you finance a new economy and you lead the world in changing to the new economy from the old economy. Many of these other countries have rigidities that prevent them from moving to any kind of a new economy. So it's a great thing to provide capital to lots of dumb ideas, because a few of them will be really, really great ideas.
And on that note,
You're